The McAlvany Weekly Commentary, covering monetary, economic, and geopolitical news events.
Sometimes, if you find a more opaque way of picking somebody's pocket, you may get away with it for a while. I've had a very tough time with a lot of people convincing them that negative real rates are a tax, which to me seems something pretty straightforward, but because it is opaque, because it is not affected through the usual channels in which you're taxed, there is quite a bit of scope for pickpocketing.
Now here are Kevin Orrick and David McAlvany.
Welcome to the McAlvany Weekly Commentary. I'm Kevin Orrick along with David McAlvany. Our guest today, Carmen Reinhart. David, I have to cheat a little bit and let you know that I did listen to your interview ahead of time. There's just so much that we can tap into. You know, Carmen is a regular attendee of the very elite Jackson Hole conference that occurs in August, that just occurred a couple of weeks ago. She's also the co-author with Ken Rogoff of a book that's a favorite of yours and mine, This Time It's Different.
Published back in 2009, that's right. So I've benefited from a number of the papers that she's written through the years, along with the books that she's published. And, you know, one of the things that I like about Carmen is that she's at the intersection of politics and economics. And she's at the Kennedy School there at Harvard, but has an emphasis on economics. Again, what I like about that is it's a blending of topics of interest, of concerns, of public policy outcomes. And it means that her perspective is not purely economics. It's not purely sort of poli-sci, if you will, but a healthy blending of the two, which I think is always a good idea.
Well, and you know, Dave, a lot of times we'll get calls or letters from listeners who listen to a guest of ours and they'll say, well, these guys are on the central banking camp, or they're on this side or that. What I found is Barry Eichengreen, John Taylor, Otmar Issing, Carmen Reinhart in this case, a lot of times, since these people are the policymakers, these are the people influencing exactly what is happening, whether you agree or not with the big picture, you better listen to what they have to say.
Well, it's very important to understand the context that we're in as investors, as individuals. And by the way, each of these people are individuals too, making personal choices in the context that they may even be setting, but they have to make their own choices in terms of how to invest, how to save for the future, et cetera, et cetera.
They share the same concerns with their own portfolios.
Even if they may be part and parcel to creating a context where those concerns get played out.
Right. And, you know, I'll tell you, listening to the interview, one of the most fascinating areas was to see the picture that she painted on how financial repression is carried out.
That's right. Actually, towards the end of the conversation, she's talking about creating captive audiences and how incentives are used. Not her language, mine here, but the equivalent of carrots and sticks to sort of drive what is now called macroprudential policies, driving audiences in one direction or the other, using interest rates, using incentives, changing the structure and allowing people to choose, but sort of limiting what makes sense in light of the variables put in play.
Well, just to bring perspective to this, Carmen Reinhart was the co-author of This Time It's Different with Ken Rogoff back in 2009. Ken Rogoff has later gone on to write a book just recently, came out a couple of weeks ago, called The Curse of Cash. And so this issue about financial repression or captive audiences is on the table right now. There are those who would say that we need to remove the cash option. Again, whether a person agrees with that or not, they better listen to the commentary.
It was very fascinating. She was talking about the opaque ways in which you have to create sort of a guise under which you can operate in the process of picking someone's pocket so that they don't know that their pockets are being picked. And so whether that is capital controls, closing the exits, Ken's version of limitations being put on currency or what have you. These are realities that are more and more the milieu in which we exist. How do we respond as individuals, as investors? If you don't understand the context, all I can say is that you're likely to be one of those unfortunate animals that is simply herded.
Well, and I'll just mention this is a longer commentary than what we normally produce. It's normally 35, 40 minutes that we ask the listener to abide by. But in this case, every minute of this interview is worth listening to at least once, maybe twice.
If the next few years are written up in hindsight as a major episode of defaults, what will the journalists and the financial market historians say about the derivatives market and the sort of double exposure, if you will, not only debts, but also the long shadow that the derivatives market casts into the financial space?
The derivatives market comes under what are often referred to as hidden debts. These are things that really encompass a lot of commitments that are off balance sheet, but that in the moment of crisis end up being transferred to the balance sheet. And so the debts are hidden before the crisis, but become manifest during and after the crisis. And I think that in the emerging world, it's less of an issue. Speaking in generalities, in the advanced economies, we indeed already got a very good flavor of, in 2008, 2009, how unaware we were of how large some of the balance sheets had become. So in that regard, derivatives played the same role as other types of hidden debts had played in the past. And other types of hidden debts are contingent liabilities of any sort, often corporate debts or private debts that end up being resolved by the public sector.
As you say, these are hidden debts. They are off balance sheet until the moment of crisis when they can be transferred on balance sheet. And it brings up this critical issue of how you define a default. Because, when you're looking at massive amounts of debt, considering the possibility of restructuring that debt, the implications of that. And of course, derivatives have been used as a way of offloading some slice of risk from one party to another. And yet it all hinges on, are we in a default? If we're not in a default, these nuances of default, restructuring, renegotiation, some of the language allows for a latitude that, quite frankly, I'm not sure we know today who holds what risk. Could you help us with that?
Well, I wish I could do a better job. I mean, the issue being, if we knew what these debts were and who held them, they wouldn't be hidden. An example where a lot of these hidden debts, derivatives in this case, that banks were the main agent, goes back to, among the more recent crises, the 1994 Mexican crisis. If you looked at 1994 Mexico, it did not look like there was that much public debt. It did not look even like there was a substantive amount of bank debt, except for the derivatives. And that brings me into the issue of how do you define a default? So, true to form, when the peso was devalued, it became aware that the banks had all these derivative contracts that they could not meet. So in that particular case, and I'm using it as an illustration of how this works more generally, the derivatives were off balance sheet. The bank balance sheet turned out to be a lot more exposed to currency risk than anyone knew beforehand. And at the time of the crisis, those contracts looked like the banks were not in a position to honor them, which would mean some large-scale defaults on the part of banks. Default is really defined as any credit event in which the original contract is not honored or cannot be honored. That means if you miss a payment, that gets classified as a default. If it comes to saying, well, I can make payments if we go instead from 3 months maturity, we make it 6 years or 10 years, a lengthening of maturities. That's a recontracting. That's also considered a default. If the interest rates on the debt is trimmed, in other words, anything that changes the original contract to terms that are less favorable to the creditor is a credit event. Of course, if there are haircuts, so if they borrowed $1 but it will only repay 80 cents, of course, that's a partial default. But they're defaults and they're defaults, meaning in terms of orders of magnitude. I'm taking this time to clarify the concept of default because very often it is thought of as just a general suspension of payments, very dramatic, a la Argentina in 2001, for example. But the concept of default is much more general than that. And I want to circle back at some point to who holds derivatives, where might the next shoe drop, or where are the surprises? But before that, I want to clarify that very often what the rating agencies are only preoccupied with are defaults on private creditors, okay, not official creditors. So last summer, Greece defaulted on the IMF, albeit it was a brief one. And then there was more bailout money and they repaid the IMF. But typically, defaults on official institutions do not carry the same weight or sometimes not even recorded by the rating agency. So that's by way of clarification of what is considered a default and on whom is the debtor defaulting on, whether it's the private sector or the official sector. Now, who holds derivatives and a lot of hidden debt? The concern has been, and the Bank of International Settlements has written a lot on this, that we do have another layer of the shadow banks, the shadow banking sector, that we potentially have a lot of risk, both in the forms of maturity mismatches and currency mismatch. And of course, this is a huge blanket statement and varies enormously across countries, but a lot of the risks with hidden debts are very much associated with shadow banking, which, is far less regulated, if it's regulated at all, in so many countries.
The paper that you wrote, June of 2015, Sovereign Debt Relief and Its Aftermath, highlights the instances of default and debt relief in the 1930s and then fast forwards to a more current period, the 78 to 2010 period. And interestingly, a lot of those defaults related to what we might consider emerging markets and developing markets. Similar issues in terms of maturity or currency mismatches or an exaggeration of pressure for those countries once there was the external debts harder to pay because of depreciation in the currency. And then just by way of comparison, your April 2012 paper for the National Bureau of Economic Research, Debt Overhangs Past and Present, I think it's interesting to look and say, okay, well, but today, most of your debt overhangs, most of your vulnerability, if you will, if we define debt overhang as a vulnerability, is actually in the developed world economies, not in the emerging markets. So to borrow from your 2009 work, it's different this time. Is this one of the defining factors for what we have on the horizon? The pressures ahead in the financial system may not be Mexico, Asia. If we go back to the bond defaults that we saw in Russia in the 1990s, but instead we're talking about the equivalent of the G7. I mean, the largest economies in the world, that's where the pressure is.
Let me point out, though, that it is different from the debt crises of the 80s and 90s, in that the debt crisis of the 80s and 90s was almost exclusively confined to emerging markets and developing countries. But it is not unlike the debt crises of the interwar period between World War I and World War II. Between World War I and World War II, the advanced economies were center stage of the debt overhang. If you look at that period, you had in the so-called the Roaring 20s, a lot of private sector debt accumulation in the U.S. and in other countries, but the U.S. in particular, because the U.S. sort of was the leader of the Roaring 20s. Then you also had in Europe a very different phenomenon. While in the 1920s, the U.S. was accumulating private debt, in Europe, it was mired with the residual public debt that had been built up during World War I. You may ask, why am I bringing this up? Well, I'm bringing this up because it was, as it is today, asynchronous advanced economy debt overhang. You could not single out that it was just the UK or that it was just France or Italy. In varying degrees, the wartime experience had left these countries highly indebted. And to jump ahead to how were those debts dealt with, it was ultimate default. And it goes back to some of the earlier remarks that I had made that the memory of defaults is not even, meaning when Germany in 1932 defaulted on its private creditors and its official creditors, everybody remembers that. But importantly, it's remembered most because it defaulted also on the private sector. But in June of 1934, the UK defaulted, France defaulted, Italy defaulted, Belgium defaulted. There were like 15 countries that defaulted on its obligations to the U.S. government. In other words, the World War I debts, and they're called World War I debts sort of as a misnomer, really, because a lot of the borrowing was done after the war to rebuild. In June of 1934, I have a wonderful series of New York Times articles describing the collective default on those debts. And I think that episode, which really was not an emerging market wave of defaults, but an advanced economy wave of defaults, is largely forgotten. And I think it has a lot of resonance for today. What do I mean? Am I saying that the advanced economies are going to go that route on a grand scale? I don't think it will be a repeat example, but I think there will be a lot of elements that will be similar. Let's start with the most extreme case, Greece. The Greek debt crisis gets going in 2010, and the initial defaults, the initial credit event involved private creditors, but the debt then shifted, and Greek debt is now largely in official hands. It's, EU government, the EU, the European Central Bank, ECB, and the IMF. So Greece is highly indebted, but it's highly indebted right now to official creditors, not unlike the 1920s. Ireland and Portugal, a lot of their debt are held also by official creditors. That is not true of Italy or Spain or other of the crisis countries where their lion's share of their debt are still in private hands. Now, am I suggesting that we're going to have this sort of across-the-board replay of what happened in the summer of 1934? No, I don't think that. I think it'll be a lot more nuanced, but I do think that we will see a lot of restructuring, beginning with debt that is in official hands. And let's face it, the amount of debt in official hands is increasing as we speak, because the part of the policy response of the ECB has been to buy more aggressively both public and private debt. So the amount of debt in official hands, including the ECB, is rising as we speak. And let me just add to that remark that I talked to a lot of people who are not aware that actually both Portugal and Ireland had a restructuring of its official debt in 2013, where maturities were lengthened and interest rates were trimmed, because official credit events are a lot quieter than when they involve the private sector.
So in this chapter of sovereign defaults, we have debt, let's say the United States. Much of our debt is privately held. It's domestic in nature and not external debt, suggesting that the approach to default is a little bit different. With external debt, you see those classic, haircuts, restructurings, extension of maturities, reduction of interest rates, et cetera, et cetera. But with domestic debt, you have inflation, which has been sort of a classic measure of dealing with domestic debt. In today's sort of creative monetary policy environment, we have, I don't know if they're new forms of repression, but there are certainly, this may get to the point which you were talking about earlier, a more nuanced approach to default, which it's just a question and a default of who is the winner, who is the loser. And through repression, through zero or negative interest rates, you are choosing winners and losers as you reduce the burden of the debt in the system. So how do we look at our current pressures and translate financial repression as a part of the quote-unquote solution to domestic debt overhang?
Well, that's a great question, and what you say is very complementary to the discussion that we had earlier. Earlier, I had focused on explicit or de jure default, which really is anything that touches a contract, whether it's held by a government or whether it's held by the private sector. But there are quieter forms of debt reduction, more opaque, that take place not by changing those contracts explicitly, but by changing the de facto rates of return on debt. which is, let me define financial repression up front so that we can talk more about that. I mean, financial repression, first of all, is not a term that I coined. This was a term that's been around for decades, going back to the work of Ron McKinnon, who passed away some years ago. Financial repression often has two pillars. One is consistent or sustained negative real returns on savings, of course, and that includes negative returns on holding government debt. And the other component of financial regression is much more heavy-handed financial regulation to get institutions and individuals to hold more debt. And the first element, which is sustained negative returns, is basically a tax. It's a tax on the bondholder. If you exposed that you have a negative 2% or 3% return on a bond, you're paying to hold that bond. You're being taxed. So financial repression is nothing other than an opaque tax. And I say opaque because it's not legislated. You know, most taxes that we pay in the U.S. and elsewhere go through a legislative process. This is a tax that is largely the outcome of having usually monetary policy being responsible for delivering negative returns exposed, real returns. And the other part, the regulatory part, so you get institutions to hold more government debt. Now, that has happened not just in the U.S., but it's been fairly widespread across the advanced economy since the financial crisis. And often the umbrella is what we now call macroprudential regulation, in which it is felt that institutions should hold more liquid assets. So you have liquidity ratios that requires banks to hold liquid assets, and the most liquid assets are government paper. And it also now extends to, the latest round of regulation that comes into effect in October to mutual funds, in which the change in regulation has also already tilted them to hold more government debt. Financial repression is not new. At the end of World War II, this time, we've now moved from the explicit defaults of the aftermath of World War I to the more subtle forms of debt reduction via the financial repression tax at the end of World War II. At the end of World War II, when I say at the end of World War II, I really mean decades after World War II also. We, meaning the United States and most of the advanced economies, had highly regulated financial markets, and interest rates were low. They were not consistently negative in the way that we are seeing in Japan and in Europe, but they were consistently low, close to zero, the way we've seen here in the U.S. But inflation, which was not the 1970s galloping inflation, but nonetheless, there was a steady dose of inflation and averaging, around 4% or so. That combination of very low nominal interest rates and a steady dose of positive inflation meant that real returns were negative about half of the time. And that helped reduce or liquidate government debt. That was a factor. And I think that factor is not hypothetical. This is what we've been living through a good part of the last 8 years, that there has been debt reduction that is lower than it otherwise would have been because real interest rates in the U.S. and elsewhere have been negative much of that time. Now, with regards to the U.S. in terms of domestic versus foreign, as you correctly noted, all of U.S. debt is issued under domestic law. All of U.S. debt is issued in dollars. But the new feature, the this time is different feature for the U.S. is that a rising share of U.S. government debt is held abroad by non-residents. And there, the haircut, if you will, is also affected if they have negative returns. It's not done de jure through, explicit debt restructuring process and so on. It's done via negative rates of return.
So that de facto change is the way that we skirt the issue of defining a default and triggering something potentially catastrophic in the derivatives market, where counterparty exposures all of a sudden are laid bare. And it seems that that's the way forward in terms of monetary policy, keeping rates at a low level. Quite frankly, it doesn't seem altogether reasonable to raise rates? I mean, we're talking about debt sustainability in essence. Interest rate normalization can't occur in this environment given the interest and principal burden. But we've removed that burden through zero or negative rates. And so when you hear the discussion at Jackson Hole or listen to some of the various regional Fed presidents talking about, okay, now it's time to start raising rates, is it realistic to do so? We have such a massive amount of debt that still needs to be addressed. The de facto approach, running a low negative rate environment, it seems like that is a course that we have to be on for maybe 5 years, 10 years or longer in order to reduce the pressure of debt. And raising rates does nothing but exaggerate the pressure of debt and actually fight what may be necessary for economic recovery. What are your thoughts?
Well, the Fed, in their stated policy objectives, of course, don't explicitly have a policy objective that involves debt reduction. That is something out of their mandate. However, financial stability is certainly not out of their mandate. This is very much, I think, at the forefront of policymakers' concerns that perhaps, during the 90s and the 2000s, before the global financial crisis, central banks had shifted to just the narrower goals of price stability and full employment and kind of forgot that we could not take for granted financial stability. I think central banks are much more cognizant about the financial stability mandate. So to deal with what you're asking, I would say that, well, one has to remember that the Fed does not have a mandate to help reduce public or private debt for that matter, but in effect, financial stability weighs in that direction. So that is, I think, an important reason why I am inclined to believe that the tapering exercise is going to be gentle compared to any past normalization that the Fed undertook in, how shall I say, more normal times. I do think that it's going to be a much more gradualist approach. Now, before I elaborate on that further, let me also say that if you look at other Fed goals, the case for raising rates can hardly be made on the fact that, we've conquered public and private debt overhangs entirely or even partially. The greatest case for Fed tightening usually cites the fact that, look, the labor market has come a long way already. In the 8 years since the financial crisis, employment looks like we're at or very close to full employment. If you also look at the estimates that the Fed, the IMF, and other substantive official institutions have put out, the estimate is that potential output in the U.S. has been drifting lower. And so that, in effect, it's not like we have a big output gap to justify continued easing. So the argument for allowing rates to rise generally stem from the view that the economy in its new incarnation, which is with a lower level of potential output growth, is pretty close to full capacity. And that there are some signs out there that inflation and wages are drifting slightly higher, closer to the 2% range, depending on what price index you're looking at. We're either slightly below, at, or slightly above, but they're drifting in the direction of the stated inflation objectives. So on the basis of inflation and output gaps and employment, there isn't a lot to go on to say, well, rates got to stay really low indefinite. And hence the discussion of policy driving rates higher resurfaces in that context. I would say that there are two things that I'd like to highlight why I think the increase in interest rates is likely to be of a more gradualist nature. One is what you've already mentioned, which is certainly there's a lot of fragility associated with balance sheets, and some of it we may not even be fully aware of. The second reason is that even if the Fed does behave by very modest allowing rates to drift higher at a very modest pace relative to what other major central banks are doing. That's tightening, because it's one thing to raise rates gradually as the rest of the advanced economies stay put or raise rates themselves. It's another thing to raise rates even gradually while other advanced economies are aggressively lowering rates. And in a recent Project Syndicate piece, the piece I wrote just before going to Jackson Hole, I did make that point that we've had a string of moves by major central banks in other advanced economies, lowering rates further or doing more QE or a combination of the two things. You know, Japan, the UK, Australia, New Zealand, of course, you know, the ECB has had a negative rate policy for some time. So even modest increases in U.S. rates, if others are lowering their rates or stepping up QE or a combination of these, really puts pressure on the dollar to strengthen. And, you know, a very strong dollar has adverse impacts on U.S. manufacturing and U.S. competitiveness. A strong dollar has been a drag on growth in the recent period. And I think when you have an economy that is not growing particularly rapidly, as the U.S. is you know, fairly modest growth, and you shave 0.75% because of a strong dollar, then you're really running close to the ground. So I think the fact that other advanced economy central banks are in a very open-ended easing mode, many of them, will also be a factor that will weigh in on the speed and magnitude at which the Fed moves its interest rate.
So in that article, you talk about devaluation, and that in a world where we have entirely fiat currencies, where the value of one floats against the value of the other, there is no sort of plumb line like we might have had under the gold standard, that it may not be appropriate to talk about devaluation. Yet it is the desire of these central banks to maintain a low level. So how should we understand, you know, what in a prior period we might have called a competitive currency devaluation, where everyone's wanting a slight trade advantage by having a lower valued currency so that they can promote economic activity domestically?
Well, you know, in the old days when you had pegged exchange rates, whether it was pegged to gold or pegged to the dollar, you know, the notorious or nefarious periods of competitive devaluations was if your domestic economy is depressed, you would devalue your currency in order to export more and import less. Obviously, if everybody's doing the same thing, it becomes self-defeating. And this is what in 1944, Ragnar Nertzi, then, you know, a League of Nations, studied, was really with long, you know, this is a much cited, it's a classic work that highlighted that, to make a long story short, that during the height of the Depression, competitive devaluations made things worse on the whole. And you're absolutely right to point out that, well, we don't live in that world. Exchange rates are floating. But the concept that you want a cheaper currency, a more competitive currency, so that you can export more and import less is alive and well. I alluded to the numerous easings that we saw earlier this year. And, you know, you can certainly talk about the Bank of Japan's historic quantitative easing and asset purchases and negative rates and all of that in the context of a very domestically depressed economy and deflationary concerns. And, you know, in varying degrees, you can make some of those arguments for Europe as well. It's hard to make those arguments for either Australia and New Zealand. Australia and New Zealand are both countries that did not have a financial crisis in 2008, 2009. Australia and New Zealand at present have had to deal with concerns about a real estate market that's really hot and booming, especially in New Zealand. You cannot really say that growth performance is nothing other than satisfactory. So why ease? Why lower rates? Well, the motivation for lowering interest rates was because they were concerned about a sustained appreciation of their currency. And, in the end, whether we see a devaluation in the old-fashioned sense that you have a pegged exchange rate and you devalue it, you make it cheaper in one shot, or whether you try to get a more depreciated currency in a floating rate environment by lowering interest rates, it's more about how it's done than what is done. So we are definitely in a situation in which central banks are very concerned about having an overly strong currency. And I mentioned Australia and New Zealand, but those are not the only examples. You look also at Sweden, for example. Sweden is also in a spot in which it's followed the interest rate policies of the ECB, not so much because Sweden has a particularly concerns about debt overhang or an exceptionally depressed economy. Sweden also does have a booming real estate market. It's followed the rate policies of the ECB because if not, you would have a substantive and sustained appreciation of the currency versus the euro, which is not seen as desirable.
Let's stay on that theme of how versus what, because it seems like we could be in an environment that sees, say, for instance, the Fed begin to raise rates, and yet, on the other hand, use their balance sheet aggressively to manage prices and rates in the open market by asset purchase programs. They currently have a balance sheet north of $4.5 trillion. It's been suggested that they could even double that under appropriate circumstances. But could you see a world in which, again, it's the how you get it done? On the one hand, you're raising rates 25 basis points at a time, consistent with your mandates of price stability and full employment, and you already have the moves in the labor markets. I'd say they're probably a little bit blinded by Phillips curve analysis on that, but that's just a personal opinion. On the other hand, you have this opportunity to expand the balance sheet considerably. What are the limits of central bank balance sheet leverage? And is that where we see sort of the next move in terms of rate repression, a la the Swedes? I mean, even your colleague Ken Rogoff has suggested, no, this is something we need to get used to. Negative rates for a long period of time, this needs to be in our staple. How you get there may not be the official policy rate. It may, in fact, be the central bank balance sheet. What are your thoughts?
Well, I started talking about a long era of negative real interest rates back in late 2010, early 2011. My first paper on financial repression was in early 2011, in which I said, this is, given the debt overhang that is a collective problem in the advanced economies, I think negative real rates are going to be with us for a while, because every time that we have seen high levels of debt, especially when it's a collective problem, across countries, not just an individual problem for one country, I think that negative real rates are going to be with us for a while. I don't have any basis to change that view at this stage. In terms of balance sheets and how it's done, I think, there are a lot of other ways that central banks are not just hypothetical. This is real-time experience that are doing that the Fed is not engaged in. I mean, for example, the latest BOJ announcement, part of that package involved doubling the size of its equity purchase from, about 3 to 6, roughly a doubling of their equity purchases. Now, I'm not going to derail this conversation but I do want to get in one historic example that I think is relevant to how much we've changed thinking about central bank policy post-crisis. In 1998, Joseph Yam, then the head of the Hong Kong Monetary Authority, during the Asian crisis, Hong Kong was getting hit on both sides by speculative attacks on the currency in which they had to raise rates, and investors were engaged in a double play in which they would short the equity market because the high rates would hurt the equity market. And what was considered terribly controversial, the Hong Kong Monetary Authority bought into the equity market to provide support to the equity market in Hong Kong in 1998. They were viewed as pariahs at the time by the central bank community. This was peanuts relative to what we are seeing done today. But this gets to your issue of, where are the central bank balance sheets going, both in terms of size and composition? Well, we've come, as I said, an enormous way in terms of adapting to what looks like a much bigger central bank balance sheet indefinitely, and one that is involved in not just buying sort of the classic government securities, but buying a lot of other assets. At the current moment, I don't see a compelling reason, or I don't discern Chairman Yellen and other members of the Fed inclined to go the route of further balance sheet expansion. I don't see that at the current conjuncture. I think a lot of debate in Jackson Hole was really about, is part of normalization shrinking the balance sheet or not? My own sense is that those balance sheets are not going to shrink anytime in the foreseeable future. I think that for a variety of reasons, the Fed will keep a very large balance sheet. However, that is a different statement than saying, well, despite what may be 25 basis point increase in rates, they're going to be doing other things to expand the balance sheet at this stage. Okay, at this stage. I don't rule out that if for any reason, this is not my baseline, but if for any reason the U.S. would look really shaky in terms of showing signs of weakness and, having negative surprises on consumer spending or investment or whatever the trigger factor may be, that, negative surprises on that score, that then process of quantitative easing could be restarted. But at this stage, that's not my baseline. My baseline is the Fed will keep a large balance sheet and will allow rates to rise. But again, to reiterate, my expectation has been that they'll go gradual. I think there's a lot of quote-unquote innovative policy tools that are being discussed. I'm not just talking about negative rates, but I'm talking about branching out into purchases of equity and branching out into other asset types of but all those possibilities are, I would say, to echo Chairman Yellen's word, things that I think the Fed will be studying, but I don't think they'll necessarily be embracing it if the economy remains pretty much on track.
So it's very interesting looking back to 1998 and Joseph Yam and the Hong Kong Monetary Authority, because that was an exception to the rule. Looking across the pond to Europe, it's becoming more the rule. And of course, if you go to Japan, as you mentioned, the idea of buying corporate equities, corporate bonds, not just sovereign paper, is becoming, again, kind of an accepted policy. Where do we begin? Coming back to one of my earlier questions dealing with just the nuance of language and how we define things. We understand one of the Fed's mandates to be price stability. How have we lost track of price stability in terms of goods and services and those prices as it reflects inflation, deflation, and finding sort of the perfect market balance there, and instead a focus to price stability in terms of asset prices, where just as Joseph Yam stepped in to create calm in the marketplace, that activity of creating price stability can very easily slip into price controls. And that seems to be what we have in the interest rate structure in Europe, where essentially you've got the central banks involved in a price control mechanism. And that leads me to the question. I'll speed up here. What do we have in terms of a historical precedent for the success of price controls?
Well, let me say that again, there's price controls and price controls. In the old days, really, price controls were just that, ceilings. It's much more nuanced. It sort of parallels to some degree, the discussion we had about devaluation versus depreciation. And look, I'm not convinced that stability of goods and prices has been forgotten in all of it. I'm not. If you look, the deflationary forces in Europe and Japan have been enormous in goods and prices. And that, of course, is something that central banks really, really have to fight, especially in a highly leveraged world. If you go back to the writings of Irving Fisher, writing in the 20s and 30s, the debt deflation problem is a very serious one for financial stability. If you have a consumer price index falling, you have deflation, then the real burden of debt is rising for both public and private sectors. And I think battling deflation is still very much a goal it's been a goal in the U.S., but we haven't had the deflationary forces to the same degree that Japan and Europe has been experiencing and is still battling. So I'm not as convinced as many are that these policies of quantitative easing and all these exceptional policies have been terribly successful. I'm not convinced of that because if you look at the last historic episode where advanced economies faced a deep financial crisis synchronously as they did in 2008, 2009, that was the 30s. And in the 30s, deflation of 6%, 8%, even 10% in some years was the outcome. So I think, the objective of avoiding those extreme deflation episodes have been very much part and parcel of, the headwinds that central banks have been fighting. I think what we forget is that counterfactual to what we've observed, which, what we observe is largely seen as disappointing, right? I mean, Japan, even after doing all kinds of, for lack of a better term, exotic policies, certainly by pre-crisis standards, still has trouble maintaining a consistent positive inflation rate and driving inflationary expectations higher. Some of those same challenges also are particularly present in Europe. But I think one has to remember that if one looks at an era in which central banks were faced with, very acute financial crises as they have been in 2008, 2009, and did not react as aggressively as they have now, the outcome was very, very deep deflations. Deflation of 1% is very different from a deflation of 10%, especially, in terms of what it can mean for bankruptcies. Again, deflation really can increase debt burdens very dramatically.
Well, on the one hand, it increases the debt burden in an acute fashion in a short period of time. And you're right to say sort of the counterfactual may have been far worse. It seems perhaps we've just exchanged the acute pain of 1 or 2 years or however many of deflation and deleveraging with debt overhang and a reduction in economic growth for a long period of time. Your paper on debt overhang suggests that when you get to a certain critical threshold, you may essentially be bearing that burden of debt, and it may cost you economic growth for up to 23 years, where that's reminiscent of what we see in Japan, but it's almost as if we need to get used to that concept moving forward for the developed world, subpar growth for a long period of time.
And that's right. But the point to be made in that regard is less about central bank policy and more about the refusal to restructure debt, because debt restructuring per se is out of the jurisdiction of a central bank. And we collectively, whether it's Japan, Europe, the U.S., in the U.S. being the more laissez-faire in that regard, and I'm talking whether it's public debt or private debt, right? In the U.S., we go back to the crisis years, and we had the foreclosure waves, which were ugly, were messy, were certainly painful, but they were swift, meaning that households did significantly reduce their debt overhang, and many of the financial institutions also. And what are foreclosures? They're defaults. Europe and Japan, in which, would have, as painful and as disruptive as such things are over the very near term, never had the same market, if you will, approach. So as a consequence, there's a lot of evergreening of debt. And evergreening of debt is the extended pretend strategy.
That's right. And it seems to me that the acute deleveraging deflation, which might take you to those -1%, -10% in terms of deflation. We saw a version of that in a small space within the real estate market in the United States. It was swift and it was done. Is there some argument that perhaps what we're doing here in central bank monetary policy is we're so afraid of the unknown that we just can't go there and are willing to take on 1 to 2 decades of subpar growth rather than see a brief, short, painful liquidation and restart? Because to me, it suggests that if we can't accept the swift restructuring, it's either because we're afraid of the boogeyman, and it may be more than a boogeyman. It may be an actual monster. It's either that or we're protecting vested interests within the financial system. I
do think there is this great fear. I mean, I'm not saying it's a combination of both, but I think where I depart from what you're saying is that it's all in the central banks. This is not just the central banks. This is, very much a fiscal policy issue. And also it comes down to actual law on dealing with Chapter 11 and the likes, which very much disfavor and penalize default and restructuring in Japan and in Europe. So what I'm saying is, and this is often voiced, I think, in some of the frustrations you hear also Draghi voice, central banks have been buying time for other solutions to materialize. It's just that those other solutions have not materialized, and the process gets drawn out year in, year out. One of the things that in my work with Christoph Trebisch we highlight on debt restructurings is that 2 of the sort of global episodes that we look at, one in the emerging markets in the 80s and 90s, and the other one in the advanced economies in the 20s and 30s. To get to the point where saying, okay, we tried all these other things and they haven't worked, we really have to bite the bullet and do write-offs, that it's taken a very long time to get to that stage. Let me put that more concretely. Roughly, not that many years at the end of World War II, countries like UK, France, Belgium, Italy, they all knew they had a serious debt overhang. And proposals for restructuring in terms of extended debt, lowering interest rates, extending maturities, those proposals started in 1922. And it's interesting, I actually have some of the proposals they made, and some of the debts that they were extending would have matured in the early 1980s. And, that was 22, and the final resolution came 12 years later. In the emerging market case of, the debt crisis of the 80s, the Brady Plan, which followed the Baker Plan, which was not sufficient to end the debt overhang and to cope with the debt overhang. The Brady Plan was concluded in the early 1990s and as late as 1994 for a number of countries. And the debt crisis had gotten underway really by 81. They were in trouble, and by mid-82, Mexico was in default. So again, it seems that policymakers just hope that something miraculous will happen and they get bailed out and they don't really have to bite the bullet. But the tendency to delay is not entirely new, although I think in terms of dealing with private debt at least, it's gotten worse. If you look at the resolution of the banking crisis in Scandinavia, the banking crisis in Norway in 87 and in Finland and Sweden in 91, those resolutions were a lot swifter. The write-offs, the cleanup of the balance sheets. They were painful crises. They were systemic crises. But they were still the resolution much faster than what we've seen in Japan and in Europe and to some degree also in the U.S.
I agree with you. There's a fiscal policy element. There's a Wall Street lobby element. There's a number of things that are sort of extending this beyond an ideal time frame. It seems like, the use of special purpose vehicles where lots of debt, whether it's private or public sector, if it came under pressure, you just sweep this all into a special purpose vehicle, not unlike what we had with Maiden Lane back in the context of the crisis. And then you can either write it down once you have your arms around it and it's not sort of held by, bond funds and hedge funds, and you're not negotiating with private parties. It is a single institution that gets to say 20%. And it seems like that's sort of the next major step, which takes me back to that idea of maybe we're not quite done with the expansion of central bank balance sheets. We don't have the events that are going to promote that or give license for it. But if we have market-driven events that open it up, that's the easiest solution if you want to deal with ultimately relieving the pressure of debt, not just through repression, but through an actual haircut of sorts.
Right. And the distinction I was making is that I completely share your view that balance sheet expansion is definitely far from over in Japan and Europe at this stage, again, barring, negative surprises on the U.S. front. I think the U.S. is not quite in that same boat, but certainly balance sheet expansion is alive and well and continuing in both Europe and Japan, because this is part of what I was alluding to earlier, that debts are being shifted to some degree from private hands to official.
Let me end with a political hot potato. Because we've already said that fiscal policy needs to play a role moving forward, do you see any difference one way or the other between a Republican outcome, the election, a Democratic outcome in the election? It seems like that has to be done. It doesn't matter who's elected. There might be a differentiation between what kinds of projects get funded or what kinds of tax strategies are employed, who pays what to whom. But isn't it inevitable at this point that either a Republican or a Democrat taking the White House in the next 4 years, fiscal policy has to be front and center?
Yet I doubt it will be, to tell you the truth. I think the next move on fiscal policy, it depends what kind of fiscal policy you're talking about. Momentum is building to increase public infrastructure investment. I think that is sort of the next wave, if you will. But some of the issues that we've been talking about also that, ultimately reach out to, dealing with, the sustainability of pensions and the like, I'm not sure that that will be at the forefront of the agenda. And I think momentum is building in Europe, and the effort to stimulate growth via increased public infrastructure projects. It just feels like that's sort of the next wave. Whether we have anything larger than that, I just don't see on the horizon.
Well, Carmen, you've got this great historical context going back, well into the 1800s, 19th century, and it puts a lot of the current policy choices in a really healthy perspective. As we see, we'll see, the introduction of new policies. What are the implications? What does this imply, et cetera?
I think right now there really is just a wave of, view that, okay, we really need to be much more aggressive. Private investment is not anywhere where we would like it to be. Let's do public investment. But beyond that, I don't really get a sense of strategy. Do you?
No, I don't. I don't see it. You've got Richard Kuh's arguments that really businesses and consumers have what they need and are not real interested in a massive increase in leverage to their balance sheets. Corporations have to some degree done that, but capital spending is still weak. They've unfortunately used a lot of their borrowings for share buybacks and things like that, and really not buying new stuff and driving economic growth. So yes, government has to step in. Yes, to prop up aggregate demand, it's going to be necessary to spend. The question is, I think the only strategy difference is whether or not it's going to be deficit spending, or we see sort of the open door for an increase in taxation to make sure we don't slip further into debt. That's
absolutely right. But you look at what either Clinton or Trump are saying, and that's just the next wave. I just came back from Brussels, the Bruegel annual meetings, big forum, did a presentation on doing debt. And my sense is that Europeans have begun to talk more or acknowledge the possibility that restructurings are not limited to Greece, but not much more than that. And the one idea that seems to have sort of made headway there is very much like what we're hearing here, that it's time to try stimulus via public investment. I'm skeptical. I'm really skeptical, to tell you the truth.
Let's say they do come out with, here in the United States, $2 trillion worth of spending initiatives, infrastructure rebuild and whatnot. Are we in a position, having defended against deflation for so long, to actually have the needle go the other direction and go from sort of low RPMs on the inflation scale to high RPMs on the inflation scale? because our bias has been so, fight deflation, fight deflation, fight deflation. Now you take $1 trillion, $2 trillion in fiscal spending, public investment.
I think part of the mentality that we're seeing transition in central banking, the enamorment with 2% inflation, just sort of grew somewhere organically, But I think what we're seeing is the beginnings of broader acceptance that maybe higher is better.
Now, is that because they'd like to keep the same policies in place longer? Why move off of that 2% target?
John Williams is one of them, but why 4% rather than 2%, say? Well, let me give you different views out there, then I'll circle back to some of the things that we've talked about that I've written about. Let's say that real rates, some idealistic steady state, are 1%, okay? If real rates are 1% and inflation is 4%, interest rate at 5%, rather than if inflation is 2%, you have interest rates at 3%, not 5%. And 5% give you more room to maneuver up and down if there are shocks to the economy. That a slightly higher inflation rate, somewhat higher inflation rate, allows central banks, keeps them further away from the zero bound, and gives them more room to react to adverse shocks.
Do your foreign creditors not protest on that? I mean, if you said, okay, now we're running a 4% rate of inflation with more and more of our debt being held by individuals overseas, I know that it doesn't matter how you pick my pocket, I'm never going to be happy with it.
Oh, but look, that's the marvel of a lot of these things, in which sometimes if you find a more opaque way of picking somebody's pocket, you may get away with it for a while. I've had a very tough time with a lot of people convincing them that negative real rates are a tax, which to me seems something pretty straightforward. But, because it is opaque, because it is not affected through the usual channels in which you're taxed, there is quite a bit of scope for pickpocketing. I mean, in the 1970s, there was all this sort of literature and money illusion, that, wage gains that in effect would be eroded by inflation were initially seen as real wage gains. The point I'm making is that I think the central bank community at this stage is getting ready for a revisit of the 2% and would be quite happy, if not outright ecstatic, especially in the case of Japan, with something higher. And one rationale, which is the one that I described, is, well, look, as a central bank, you're further from the zero bound and you have more room to maneuver. From the work that I've done, I've been saying for the last 6-7 years, look, the effective in terms of debt reduction period of financial repression involved a combination of keeping low nominal rate close to zero, never really negative, but close to zero, but a steady dose of inflation. Inflation, some years was 3%, some years was 5%, but it was definitely on the whole somewhat higher than what we've had since the crisis. Now, the real trick is, of course, how successful are central banks in making sure that then it doesn't go from 4% to 6% or higher. But I think that is sort of my sense where things are moving, because a 4% inflation does erode debt twice as fast as 2%. In addition, as I said, I do think that it can be useful in providing a bigger scope for countercyclical policy for the central bank.
Do you remember the Summers-Barsky thesis? Larry Summers, this goes back to the 80s, and he did a study and basically looked at negative real rates of return being an environment where investors tend to opt for assets like gold, and it's basically just opting out. If a market return is not positive and yet you're still taking market risk, then you just sit out for a while. And so gold tends to do well under those environments of negative real rates of return. That's, in a nutshell, the Summers-Barsky thesis. I'm curious because cash is as much of an opt-out as gold would be. And I'm curious if you've ever had interaction with Ken Rogoff on this point, because his suggestion, he just published a new book this month on the curse of cash.
Right.
The idea, and it's an elaborate argument for why, we need less of it. And maybe from a social, cultural standpoint, we'd all be better without it. But the real heart of the message is we can't effectuate a negative rate environment if people have an opt-out. and he cites his disagreement with Ottmar Issing on that, where Issing says, look, you can't take away coined liberty from people, nor should you, which is what Issing thinks currency is coined liberty. Where are we going where, whether it is running inflation at 4% or at 2%, and we're dealing with negative real rates, or if we're actually in a negative nominal environment, is the only way of making that happen basically closing the exits for everyone?
Well, look, never underestimate the capacity of governments to do that. You mentioned sitting it out on gold. That was not a possibility until the 1970s in the United States.
That's right.
When, during the Depression, the abrogation of the gold clause came in with all kinds of controls and prohibitions of and transactions on gold. And so closing exit doors, which is what capital controls and Keynes limitations on currency, and part of financial repression, a big part, is you create captive audiences, okay? And part of how you create captive audiences, well, some of it can be via incentives, quote unquote, i.e. macro-pru says, well, for banks, you're better off having these higher liquidity ratios. It keeps you healthier. But some of the measures of that era involved closing other options, because if not, the quest for yield or your own preferences. In the case of cash, if you have no yield on less liquid assets, why hold them when your option is cash? Or if you have options for less liquid assets that bear a high return, why hold the lower return ones if you can? And I think right now the limitations have been also coming in simply from the availability of other alternatives, right? I think many institutions would love to hold more high-yield paper if they could, but who offers high-yield paper? Emerging markets. Well, that's not that readily available. And also regulation limits how far you can take that. So you hold cash. The general point that I'm making is one can never underestimate how restrictions on alternatives help shape those captive audiences.
Do you think that has an echo of Keynes going back to sort of destruction of the rentier class, where it's just we need to get the money in the system? By any means, get the money in the system. Don't let it sit there passively, collecting a magic 5% or collecting anything. We need the money in the system. Does it have a ring of that to it?
Well, look, debt overhangs need a transfer from the creditors to the debtors. Whether they get that transfer right away cleanly with a capital levy, i.e. a default, a haircut, it is a capital levy, or whether it's done more gradually through negative returns and restrictions on what kind of portfolio you can hold. But one way or another, creditors obviously do not want to make that transfer. So it is teeth pulling. This era that we talked about, the interwar years, there's actually a wonderful book edited by the late Rudy Dornbush and Mario Draghi. It's a book on debt. And there's a paper, it's a very nice paper by Barry Eichengreen that sort of reviews the discussion, the popular press and the discussion of wealth taxes that was so prevalent in the interwar years. Let's not forget that one way or another, the rentiers, the British upper classes, got hit with a whole slew of new taxes at the end of World War I. Inheritance taxes, property taxes, all kinds of new taxes. So it's part and parcel of the debt overhang resolution. I think one of the things enormously slowing Europe down is that the creditors and debtors are in the same bag. And the creditors, of course, are the big foot on the EU decisions. So, you seldom vote against yourself. But it's hard to imagine that sooner or later these debt overhangs will not be resolved with a transfer of one form or another.
Carmen, when you look and say, okay, well, this book that I wrote, decent royalty income from that, and my post at Harvard, a decent income, and I live beneath my means, so here's some savings. You may not be the British aristocracy, that rentier, who is moving towards sitting in the crosshairs with new taxes and fiscal solutions, including squeezing those who have anything or something in order to sort of settle accounts and create greater equality, as happened post-World War I. But how does Carmen look at that? Do you say, well, I'm going to keep a diversified portfolio and hope for the best? Or do you say, gosh, this is tricky. Maybe I do want some cash. Maybe I do want something as low profile as gold. Or do you just say, no, look, I don't care. Look, I have problems to solve, and we need to create the best possible solutions for the general public, and I'm not really worried about that. I have my daily bread, and that's enough.
Well, my view, first of all, is sort of, and I'm not making light of this, is the potato chip theory, which is you go to a supermarket and you see a bag of potato chips that's roughly the same size as what was there before and roughly the same price as what was there before. It just happens to have much fewer potato chips inside, which is you got a haircut. That's how I think of pensions, first of all. So I save commensurate to thinking that pensions are at risk. That's why I said there's many ways of fooling people. And the strategy adopted by marketers in which the size of the bag doesn't change that much and the price doesn't change that much. But when you get right down to it, the content did. You're getting fewer goods and services in the future for your saving, fewer goods and services for your pension. And therefore, part of it is planning accordingly, sort of being risk averse and trying to, internalize that. And beyond that, I'm really looking at sort of a lifestyle provision of goods and services and having adequate savings to meet that. It's diversify, but with the full expectation that taxes come in many ways, and some of them are quite disguised, so that the idea that in the future the inflation tax may rise, I think, well, real estate has not been bad for that. I think longer term, cycles come and go. I still think emerging markets as a class have promise. This is someone who's written a lot about defaults and so on, right? And this is not just a sort of cyclic search for yield, but you do look at a core group of countries where we have seen convergence start to happen. Advanced economies have demographics going against them. Even if emerging markets remain emerging markets and volatile and everything, I think long-term real rates of return will warrant a presence there. So these are small things, that under the diversification, just being prepared for, when I say lower transfers, is the same thing as saying higher taxes, really.
Well, listen, thank you so much for the generosity of your time and sharing your mind with us, not only in today's commentary, but in the research that you've been doing, the research that you're still doing. I thank God for academics, because you shrink the world and copious amounts of study and research into more digestible quantities. I'm still fascinated by bibliographies and sample from them routinely, but I also recognize that there's about 100 times the work that goes into that distillation process. So I'm grateful.
Well, thank you. It's really been a pleasure to talk to you.
You've been listening to the McAlvany Weekly Commentary. I'm Kevin Orrick, along with David McAlvany and our guest today, Carmen Reinhart. You can find us at McAlvany.com. That's McAlvany.com. Or give us a call at 800-525-9556.
This has been the McAlvany Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McAlvany Weekly Commentary.